How Capitec became one of South Africa's biggest bank. The consumer banking industry is notoriously difficult to enter because most customers rarely switch banks, and in some countries, people change spouses more often than they change banks. The banking industry in South Africa was no exception. For decades, the industry was dominated by the Big Four: Standard Bank, FNB, Nedbank, and Absa. However, in 2000, a new player entered the industry called Capitec, which started establishing branches rapidly. By 2007, it broke through the barrier of 1 million active customers. 10 years later, it had more than 10 million clients and about 800 branches. It has now become one of the largest banks in the country. What about profits? After breaking even in 2002, net profits continued to rise to 3.8 billion rand in 2017, which is about $260 million. While the company's share price appreciated by 19,000%, the stock was 117 and went to 2,200 rand. In 2016, the Lafferty Group ranked Capitec as the biggest bank in the world, an achievement it repeated again in 2017. The customers seem to agree. Surveys indicate that Capitec has the most satisfied customers of all banks in the country for approximately 5 years running. Capitec gets many things right in terms of strategy, including its market positioning, internal operations, and organizational culture. Yet, 3 things stand out that enable it to grow and prosper. Resisting revenue temptations. Founder and chairman Rian Stason said that Capitec's strength has always been its ability to focus. Indeed, Capitec is more focused in terms of what it does and does not do than most companies and certainly most banks. It serves individuals only, not companies or trusts. It offers them a single account. Everybody got a gold card with exactly the same conditions, prices, and services. A customer can do 3 things with this account: savings, loans, and transactions, and nothing else. The bank serves these customers through a network of highly efficient physical branches. It has always held on to this model and never wavered. Companies, and certainly new entrants looking for growth, often find it difficult to resist jumping into various new forms of revenue. That's understandable, because if you're looking for growth, any piece of additional revenue seems welcome. Moreover, in advance, you can never be entirely sure what your original market choices will play out and will generate sufficient income by themselves. Hence, when a new potential stream of revenue presents itself, the company's management feels it cannot afford to just leave it. The result of this is that a company ends up doing a variety of things that each might make sense on an individual basis, but in combination create costly complexity, not adding up to something that is bigger than the sum of the parts. Or, as the late Steve Jobs said, microcosmically, it might make sense, but macrocosmically, it doesn't add up. In order to grow, a company needs a consistent set of choices. Put differently, a company needs focus. Stanford professor Robert Bugelman called it a vector strategy. All the parts of an organization and all the combined efforts of its people need to be working in the same direction. Adding different related sources of revenue gradually decreases strategic focus. Capitec resisted the temptation of adding additional sources of revenue that might appear attractive on an individual basis. For many years, it did not offer anything else other than its single account. No insurance, no currency exchange, no small businesses. Recently, however, it has added credit cards to its offering and has begun to offer funeral insurance. This, however, is only after it has firmly established itself in the South African market, and that is the point. Developing purposefully. Although Capitec has always been remarkably focused in terms of client segments, its product portfolio and distribution network, its strategy has changed significantly over the years, as it had planned. Capitec first entered the industry in rural areas. These areas were underserved by the traditional banks. That is because most people living there are quite poor, and the banks figured they could not make much money on them. There were, however, plenty of micro-lending businesses in these areas. Offering unsecured payday loans, Capitec started buying them up and converting them into bank branches. The big banks ignored Capitec. After all, this new entrant focused on the bottom of the market only, something they weren't interested in anyway. However, after Capitec had established itself in these rural areas, it started entering the larger cities such as Cape Town, Durban, and Pretoria. It set up branches near taxi ranks, stations for minibuses used by people who gradually cannot afford a car. Still, the big banks dismissed Capitec's efforts in targeting these potential customers who already had a bank account and represented the low end of the market, where margins and profits were thin. The big banks happily left them to switch to Capitec. Yet, Capitec's management was thinking ahead. After it had established itself in these cities and gained a well-known brand and reputation, it started setting up branches in high-end shopping malls. The big banks were rattled, but by now it was too late to stop the new kid on the block. Capitec's foothold was now firm, and it continued growing. Capitec's strategy is a reminder of Harvard Business School professor Clayton Christensen's model of disruptive innovation. It did not enter the industry taking its competitors head-on by offering superior products or services. Instead, it focused on the bottom of the market and gradually yet decisively worked itself upward. Now that is firmly established, it can afford to change gradually its model. Capitec's strategy is a reminder of Harvard Business School professor Clayton Christensen's model of disruptive innovation. It did not enter the industry taking its competitors head-on by offering superior products or services. Instead, it focused on the bottom of the market and gradually, yet decisively, worked itself upward. Now that it is firmly established, it can afford to gradually change its model. Many entrants into the industry try to offer something new and superior to potential customers, hoping to do even better than the existing players, often targeting the customer segment with the highest margins. But sometimes, an entrant's chances of success are better by focusing its offering on something that is being ignored. Successful corporate strategists then look ahead and realize that once they have grown, their strategy will likely need to evolve. This does not mean adding things to their company's portfolio or value proposition. It also requires seizing some of the old parts of the original strategy. In Capitec's case, for example, not a single one of its branches that were converted from micro-lending shops are still in operation today. Capitec's management realized the company had moved on and that those branches needed closing. A focused strategy is important, but allowing or even planning for that focus to shift in the future is equally relevant. Breaking outdated habits. Capitec's founders had learned something from their early days in the industry, including the cash loan shops. Companies in the industry seem to share some puzzling practices. For example, in contrast to the loan shops, all banks in South Africa closed at 3:30 p.m. As Michel Leroux, co-founder and former company chairman, mentioned that this practice that is a leftover from the days that money was physical, bank employees needed an hour or two at the end of the day to count the money and balance the books. Even though most money is electronic and balancing the books happens in the blink of an eye, banks continue to close at 3:30 p.m. Capitec, by contrast, decided to keep open its branches till 6 p.m. or even 8 p.m. and on Sundays to accommodate the needs of working customers. Similarly, across the industry, banks charge a fee on transactions that was a percentage of the sum transferred, which was probably a leftover from the days that money was transferred by check rather than online, to account for the costs of potential loss or theft. Capitec instead charged a fixed fee, regardless of the amount being transferred. Customers loved it, but incumbents found it surprisingly difficult to imitate the practice. Their percentage-based fees were interlinked with various other aspects of their model, such as the budget of their departments, managers' headcount, and the bonus system of the executives. It enabled Capitec to remain unique in its offering for an unexpectedly long time. But it was not only particular practices and systems that Capitec organized differently than traditional banks. It was the whole attitude of the company and its employees, particularly toward customers. In traditional banks, customers had to line up. Branches and bank employees could be bureaucratic and intimidating. The inner working of the banks sometimes were oppressive and not transparent. Capitec's founders had noticed that the cash loan shops often seemed to treat customers much better. Similarly, they decided that Capitec would treat people as they were, customers. They would be asked to sit down rather than line up if they had to wait. They would look at the computer screen together with the bank employee serving them, rather than face a window or a desk, and they would be made to feel like visiting a retail shop rather than a banking office. To facilitate this cultural change, Capitec decided to not recruit people from other banks, but hire former retailers. By focusing its new business on removing the industry's outdated practices, Capitec brought a new model in the industry. Gerrie Fourie, its current CEO, called it innovating around frustrations. Companies in well-established industries are often remarkably alike. They do more or less the same thing, and often have all been doing it like that for many years. Sometimes industry insiders just shrug their shoulders when asked why it has to be done that way, proclaiming, "That is how we've always done it." Sometimes they might even refer to the industry's best practices. But best practices can turn bad as a result of changing market conditions, customer demands, or progressing technology. Innovating by stopping these traditional practices can become a source of growth and competitive advantage, just as Capitec has done. Will Capitec's success last forever? Probably not. Few things in life do, and business is certainly no exception. The other banks have finally started to catch up. Moreover, after 18 years, Capitec is now an incumbent too, and new innovative entrants may one day disrupt its model as well. What's more, the company still relies heavily on unsecured loans, a business that is obviously notoriously risky and hard to value. But so far, Capitec's growth strategy has revealed some lessons for any company that is trying to grow in a crowded, competitive market. It is a story of focused evolution, based bravely on leaving the outdated practices of the industry's dominant players.